One. Welcome back, everybody. Thank you for joining us this week in America on the Blue Funk Broadcasting Radio Network. As promised, talking with Roger Lowenstein, author of the excellent new book, The End of Wall Street, a gripping account of the 2008 financial collapse. Roger, first of all, welcome to This Week in America. A pleasure to have you with us on the program.
Rick, it's good to be on the show.
Thank you. The title, The End of Wall Street, you've said, actually works for a couple of different ways, a couple of different mindsets. Let's start, first of all, The End of Wall Street, because some of us thought maybe this is the end of Wall Street as we know it.
Well, that's right. You know, when I wanted to bring back and evoke in people's minds those very chilling weeks in September and October of '08, when it really seemed like they were going to, pave over Wall and Broad and turn into pasture because we wouldn't be trading stocks again. Well, of course, that didn't happen. The other meaning of the end of Wall Street is this book isn't just about the end of Lehman Brothers or the end of Bear Stearns or Fannie and Freddie. It's the end of an era, of an ethos of absolutely unregulated markets, when it was believed that there was no need for government to regulate in any way banking or Wall Street. It was led, of course, by Alan Greenspan, who said famously that derivative deals negotiated by private bankers don't need regulations. When it was believed by Ben Bernanke that it would reach the end of the days of painful recessions and mass layoffs and everything because the Federal Reserve had perfected the art of managing the economy. That Wall Street is the Wall Street that we knew in the 90s and O's. That's the one that's ended.
How close did we come to a real financial catastrophe?
Well, I think, we had a real financial catastrophe, and in some senses, we're still having it. It's very nice that stocks have rebounded and that people on Wall Street are feeling a little better again, but 8 million people in this country lost their jobs. We have fewer people working in this country now than we did 10 years ago, even though we have a population that's 30 million higher. And most of those people, by the way, who lost their jobs were not on Wall Street. They were bakers and butchers and candlestick makers, as they say. And that is my definition of a real financial catastrophe, when the damage spreads beyond Wall Street and causes such pain in the ordinary economy.
Will we see Wall Street like it was before? And I say that because it sounds like, no, things are changing. But I hear an ad the other day for a mortgage company talking about a no-doc loan, and I'm thinking, didn't anybody learn from this?
I'm very disappointed to hear that there are no-doc loans again. I don't think you're going to see 100% financing. One of the big characters in the book, Angelo Mozillo, in the early 2000s, was going around the country saying every American is entitled to a mortgage, as though a mortgage were a matter of an entitlement and not of a matter of the credit you had and the capital that you could put into the house. Mortgage regulations have tightened up. Banking regulation has tightened up. And there are a whole series of areas now that are before the Congress, now that the health care reform is behind them. And we'll see, I think, in the coming weeks. I heard that there are approximately 25 banking lobbyists for every legislator in Washington. We'll see if they can stand up and pass some reforms, or if they knuckle under.
You mentioned 100% loans. I can remember seeing that they would give you 125%.
That's right, because they would have add-ons. I mean, you wouldn't get that all in the first step, but you'd get an
Right.
extra loan as you walked out the door, and that's of a value that was highly inflated. We know that at places like Washington Mutual, another character in the book, Kerry Killinger, was on the Hill yesterday complaining that the feds, shut them down too soon and everything. But they were putting pressure on their appraisers to come in with higher and higher loan values. They had a slogan at Washington Mutual: a thin file is a good file. That meant they didn't want a lot of information about the applicant. They wanted you to come in, they wanted to originate the loan, and they wanted to get it out. They wanted to sell it to Wall Street. And they were counting, obviously, on the credit rating agencies to put a seal of good approval on so they could get that thing out of Wall Street and to investors around the world. And they had this sort of daisy chain set up. And that's a big reason today we've got, 5 million underwater mortgages and so on.
In the book, The End of Wall Street, and we're talking with the author, Roger Lowenstein, you actually talk in a case at Washington Mutual where a guy is sort of doing, as they say, his due diligence. He's got an application. He's checking it out. He's getting reamed by his superior, like, don't bother checking. In fact, when he checked, he found out some of the information was incorrect.
That's right.
It's ignore it and go on.
That case in the book is a real case. Someone puts in their application for a loan, for a mortgage, that they have $150,000 in their bank account. And a junior person at Washington Mutual checks and calls the bank and finds out that the account is only $5,000, and he is reamed out by his supervisor. The fellow says, we don't call the bank. There are similar examples with Countrywide, which is, perhaps the poster boy for easy loans, easy mortgages. Someone goes in and says in their application that they're applying for a mortgage for a primary residence, and there's a trainee there who notices that this fellow has 3 other mortgages, all with Countrywide, and says to his boss, maybe we should check to see, is this really a primary residence? Primary residents, of course, are considered better risks. And the supervisor says, absolutely no. We go by what's on the application. They didn't want to know. They wanted to push loans out the door. The head of WAMU, Kerry Killinger, used a very revealing motto. He said, we're in the retail business. If you think about it, retail is concerned with a single moment when you make the sale, when the person goes in, buys the pair of jeans or whatever it is. That's all you care about. Banking is different. The key moment for a bank isn't when you originate the loan. It's when the money's paid back. And that's the thing the bankers forgot.
A term I've heard a lot of recently, especially as they're talking new regulation now, is risk retention. And I'm so old I can remember our first mortgage, we actually kept making payments to the bank that gave us the mortgage. Then suddenly you go through this, like every couple of months, you're sending it to a different place. Was that part of the problem, that people got their money, sold it, and got out?
That was part of the problem. In the old days, our fathers or grandfathers, you got a mortgage. The banker kept that mortgage for 30 years, so they were going to make pretty sure that you'd be a good credit risk, because if not, it was on them. These days, obviously, mortgage banks don't keep the loans for 30 years. They probably don't even keep them for 30 days in many cases. 30 hours might be a close estimate. So, they lost interest in whether or not credit was any good. Some of the bills before the Congress now would require that the banks keep at least a small percentage of their mortgages on their own books. So if they go down, if the mortgages go down, the banks suffer a hit. I have to tell you that the experience of banks that kept mortgages, for instance, Golden West in California, was absolutely no better. They made just as many bad loans. So this crisis, so to some extent it was greed. To some extent, banks just drunk the Kool-Aid, and I think started to believe what they wanted to believe, which was, no matter how bad the loan was, the customer would be able to find another bank to refinance it. They were betting on the bigger fool theory. This crisis was so big that you can't pinpoint just one cause. The banking system really broke down across the board.
Well, and people look at that and they go, wow, this all happened in 2008, like out of nowhere. And you make a point, you saw it coming, and you can go back to 2007. You go back to your book, When Genius Failed, back in 1999, and you even make the argument you can go back to the end of the 1970s where you saw this, the genesis of this.
It's, one thing I learned in doing the book is I was surprised at how much trouble was on the horizon way before that weekend where Lehman failed in 2008. In fact, by that point, even before Lehman failed, foreclosures were up to 300,000 a month. That was a quadrupling. Delinquencies had tripled. Job losses had been going on for 9 months in a row. We'd already lost 1 million jobs in the economy by the time Lehman failed. This thing was going down way before then. And you bring up the LTCM failure, long-term capital management in '98. That one really hurts because I wrote a book about that, and there were really 2 lessons I thought out of that experience. One was massive leverage, massive borrowing by financial institutions gets you into trouble. And the other is you can't rely on these computer models that these academic whizzes love to throw around. They look at past history of trading and they predict what's going to happen in the future as if yesterday's weather is going to tell you what's happened tomorrow. And that's what happened at LTCM. And those 2 sins are exactly the sins that banks committed this time. They leveraged to their eyeballs and beyond, and they all believe that these models of what happened in the past and mortgage foreclosures would be able to predict what happened in the future. Well, once we started issuing mortgages with completely different standards, meaning more lax standards, those old models, they didn't tell you anything about the future. It's like looking at traffic reports from the era of the horse and buggy and trying to predict what's going to happen in highway fatalities in the future. It's completely meaningless.
You're listening to This Week in America and the Blue Funk Broadcasting Radio Network. Roger Lowenstein is our guest on the program, author of the excellent new book, The End of Wall Street. The book's available all across the country. And it's interesting that you mentioned that. Sort of the theory was if it hasn't happened before, chances are it's not going to happen in the future.
Yeah, firms love. There's an old saying that to a man with a hammer, everything looks like a nail. And firms think that if a tool is available, it must be useful. The tool in this case is econometric modeling. So these Wall Street firms love to run all their the history of market trading through their computers and try and come up with what the future is going to bring. If you had asked one of these computer modelers what are the odds of a tremendous recession rivaling the Great Depression, if you'd said that to them 3 years ago, they would have said 1 in 1,000. That hasn't happened since the 1930s. Well, if you ask them today, they'd say, 1 in 5 or something, because we just had one. Just because we have these computers and we can run past history through them doesn't mean that they're going to predict the future. The financial markets are not like games of chance. We know with a deck of cards that we can predict what the Queen of Spades is going to come up on every, one out of every 52 draws, and we know that amongst 1,000 people there are going to be so many people who are 6 feet and so many people who are 5 feet 8.
You're right.
These natural phenomena occur with certain predictable frequencies, but you just can't tell what the odds of a financial panic are, because one person panics and then it spreads and then it spreads. They don't obey the laws of physics, and believe it or not, in all these firms they have these quants, and that's what they do. They think markets are just a bunch of bouncing balls obeying the laws of physics.
As this is all happening, I'm trying to understand all these complex securities, and I'm really struggling with this, and I was glad to read. You're basically saying a lot of bank executives didn't even understand what their own traders were dealing.
Yeah, that's a real big problem as the complexity of these securities grows. You had mortgages that were bundled up into securities, and bonds were sold against them, and at one level, and then you had these clever bankers and took these bonds and put thousands of these bonds together and made a new bond with them. This is a secondary security, not backed by mortgages, but backed by bonds that were backed by mortgages. And then they started getting really clever, and they had bonds that were backed by bonds that were backed by bonds that were backed by mortgages, so that nobody but the traders down in the bowels of the basement of these firms could understand these things. When the mortgage market froze, that was in the summer of '07. Again, this is 13, 14 months before Lehman went down. Stan O'Neill, the head of Merrill Lynch, called his guys in and said, "Well, how much of this stuff do we own?" And he runs the company, right? And he was informed that Merrill actually owned $50 billion of these CDOs, and that was the first he knew of it. And he knew right then that the firm was dead. And it was.
You talk about absence of fear. In fact, that's one chapter. You talk about some letters written, I think it was the city officials, where they really seemed oblivious or didn't want to acknowledge, there are some risk here.
Absence of fear relates to a guy named Bob Rodriguez, a mutual fund manager in Los Angeles, and he's really one of the heroes of the book because he sees a lot of this stuff coming. In fact, he has a dream about 3 years before it all happens that these firms are going to fail, and he bails out. The specific chapter you're inferring is a very interesting one, because he goes to a meeting of one of the credit rating agencies, Fitch, which is putting these AAA ratings on these mortgage securities, and he says, what is your assumption? You must have some assumption about the future to say that these mortgage bonds are AAA. And they say, well, our assumption is that real estate prices are going to continue to go up 2% or so a year. And so then he asked them, well, what would happen to your models, if let's say, prices only went up by 1% or so a year, and they say, well, then we'd start to have trouble. And he says, and what would happen if real estate didn't go up at all, if it just stayed flat? And the man from the rating agency says, well, then our models would completely break down. He didn't even ask him what would happen if real estate could go down. They couldn't even fathom that could happen. So he realizes then that all these bonds, and there are hundreds of billions of them sold to investors around the world, are based on a false premise, or rather on an extremely risky premise that this is going to be a market that continues to rise forever. Well, when have we seen a market that continues to rise forever? How little history these people must have had of Wall Street and markets, how much hubris to have built that into their models.
We've got about 30 seconds left. I have to ask, have we learned anything out of this? As we go forward, the government's talking about new regulations. Have we learned, and will we prevent this in the future?
I think this generation has been somewhat scarred, and I think it's up to the Congress to translate the shock that we've all felt into some meaningful protections. And I would suggest one to start out with. If you want to avoid 14-car pileups on the highway, you post speed limits. The way you post speed limits in markets is to limit the amount of debt, limit the amount of leverage that financial firms can run up. And I think that'd be a very good start.
The book is called The End of Wall Street. It's available. It's a bestseller, available all across the country. Roger Lowenstein has been our guest on This Week in America. Our website, thisweekinamerica.us. You can log on and link on to information on the book. Roger, an excellent account. We've only touched the surface. I advise everybody to get the book. It is a very chilling account of what happened during the financial crisis of 2008. Thank you for joining us on This Week in America.
Thank you, and a pleasure to be on the show.
Thank you.